So right now, listed public REITs represent 6% of commercial real estate in the US. 6% of the commercial real estate in the US is listed. So, that number alone is going to go up. Asset managers in the US own about half of all the stocks on behalf of their clients. They own 3% of the commercial real estate. So it's very easy to see this asset class becoming increasingly a focus of the listed markets and the asset management world over time. I think that's going to happen. I think it needs to happen because you get better liquidity, better governance, and all sorts of benefits to being listed publicly. So, I wouldn't be surprised if we see it double or even triple over the next 10 years.
Hello and welcome to the Achieving Alpha podcast. My name is Stephen and I am the host of the show. Today, I'm delighted to be joined by Phil Bak. He is the CEO of Armada ETFs. And before that, he was the managing director of the New York Stock Exchange. Today, we have the pleasure to talk to Phil all about ETFs. And it's really great to have you on the podcast, Phil. How are you today?
Glad to be here. Thank you so much for having me on.
Yeah, it's really great to have you on. This is the first time on the show that we've actually delved into REITs as an asset class. So it's really good to have someone with your experience on the podcast to be able to tell us a lot more about them. So as it's your first time on the podcast, I just wanted to ask you if you could just give a little bit of an introduction to yourself and also a little bit about Armada ETFs as well, the company you run.
Sure. So, I've been in the ETF and fintech and investing space for my whole career, but I'm actually new to REITs myself. I discovered REITs about 2 years ago. I did a few other things you mentioned at the New York Stock Exchange. I also worked for a couple of ETF companies and built some innovative funds. This is actually my third startup, one that succeeded, one that didn't. We had a company that did sub-advising of ETFs, launched a couple funds that people might have seen or come across. One that we called the reverse cap weight, the inverse of market cap. So we're extrapolating the equal weight premium, one that used customer satisfaction as a leading indicator. And, I came to this sector, this asset class, I think as a bit of a reaction to, like a bit of an overcorrection to what I was seeing in capital markets, which was the disconnect between intrinsic value and price, right? Where things are just, trading based on vibes, on momentum, so many flows that are just, following market cap weight or passive indexing. And I was looking for something that was a little more tethered to something tangible, something real, something, that had, intrinsic value, a building, right? A commercial real estate building. You can knock on the door, you can look and you can see tenants, you can see people running businesses out of there, people living there. It's not as, now there's not to say there aren't issues of leverage and financialization. There are, and we'll talk about those. But there was something comforting about getting into an asset class that was a little more rooted in real tangible buildings and things like that. And so, we started Armada about 2 years ago. We have 2 ETFs that currently trade, one that tracks the residential REIT subsector and another that is more of a broader factor approach to the entire real estate sector. We're working on some other pretty interesting things. Some I could talk about, some I can't. But, really our North Star, what we're trying to do is bring institutional commercial real estate investing strategies to the public in ways that make more sense than the options that are available to them today.
Awesome. Okay. So you mentioned you had 2 ETFs, right, at the moment. How do you go about selecting what are the best REIT assets to go into those ETFs? What is your full process behind that?
So the 2 ETFs are very different from each other. The residential REIT ETF is very simply residential REIT, but we've gone to an equal weight approach because a lot of the smaller REITs were getting bought out at really favorable valuations. And we expect that trend to continue. So we went to equal weight in order to bump up the representation of the smaller REITs within the bucket, which has worked out very nicely. We've got, tremendous outperformance relative to the market cap weighted benchmark on a year-to-date basis. But it's a very simple, straightforward approach. The other fund uses what we call REIT factors that matter. And when you look at quantitative factor investing, which has been popularized for quite a while now, and you look at the factors that are used, some of them are applicable to any stock that trades, right? If you look at momentum as a factor, for example, it's really the same whether you're talking about an operating company or a commercial real estate building. But there are other factors that just don't apply in the same way to real estate as they would to an operating company. For example, price to book, right? That just doesn't work in real estate. And conversely, when you look at real estate, right, if you're looking to buy yourself a commercial real estate building outside of the public markets, you're not looking at REITs. You're just an investor who wants to buy off market, let's say a warehouse or some industrial building. The factors that you would look at, right, occupancy vacancy rates, supply demand imbalance, migration trends, location data, obviously, is critically important, and a number of other factors. Those factors are ignored by public market investors that are using traditional factor models. So what we're calling it is REIT factors that matter. These are the factors that matter to real estate. We're embodying them in an ETF, in a systematic rules-based strategy, and that's what we're doing. It's worked out quite well for us so far.
Okay. And what are the positives about investing in REITs over just investing yourself in some type of real estate, whether it's commercial or residential?
So it's a very simple question, but a very complex one too, right? So right now, if you were to invest in real estate, and I talk about like public versus private as a dichotomy, if you were to go invest in privately held real estate, or if you were going to invest in a public market REIT, the valuations of those two assets, same building, let's say it's the exact same building, the valuations and what you would pay are dramatically different. Not only that, the factors that make up those valuations dramatically different, which doesn't really isn't something that you would expect to continue on an indefinite time horizon, right? The building is the building. It doesn't care if it's listed privately, if it's in a private REIT fund, or if it's trading publicly on the exchange. You would think that the valuation would be the same, but it's not. And that creates an opportunity. Today, what we're seeing is that the valuations on the public market real estate are dramatically lower than they are being marked on the private side, which is, again, just a tremendous opportunity for investors. A lot of reasons for that. One is they got, knocked down by beta quite a bit. There's a lot of investor anxiety post, COVID for office, which, rightfully so, based on leverage and rates and refinancing costs and a number of factors. We have models that take those factors into consideration, normalize those factors as well as the factors for private. And we're still seeing that the valuations are extremely favorable by and large for public market REITs relative to private real estate. So again, that's where we focused. And we came to that conclusion. We are focusing there because we came to that conclusion, not the other way around. It's not necessarily a permanent state, but that is what the landscape looks like today. You get better liquidity, right? You get better valuations, and you don't have management headaches. It's a big joke. If you go and you buy real estate yourself as an investor and, you're getting calls at 2 a.m. because there's a leak and you have to go find a plumber or go fix it, right? It could be a major hassle. If you buy a REIT in your regular equity trading account, you have no such troubles. They pay high dividends. There's a lot of benefits to it, a lot of economies of scale that are achieved as well by investing in REITs. So we love the asset class.
Yeah. And I believe there's some tax incentives as well from investing in REITs over directly investing in real estate. Is that correct?
Yes, that's right. Mm-hmm. And that's a pass through from the real estate firm. Now, you can be a REIT, a real estate investment trust. You can be a REIT and achieve those tax benefits and not be listed publicly too. But then you lose the liquidity. So, but the tax benefits do apply to all the publicly listed REITs.
All right. And do you actually go out and sometimes go and see the properties, whether it's be residential or commercial? And I also wanted to ask you a second question on that as well. What are the type of tricks that you need to kind of look out for when you're doing REIT investing, things that maybe they tried to pull the wool over your eyes on, something that you need to look at carefully?
So I actually wrote a blog post about it one time where I was having this kind of existential crisis about markets and what I was doing, in markets. And, is at some point there was some, crypto nonsense, or maybe when FTX blew up. I don't remember exactly the impetus, but, I wrote about this. I was having this, wanted to like make sure I was investing in tangible, real stuff and on behalf of my clients and myself. And I went and drove over to an affordable housing complex that was near where I live in Detroit that was owned by one of the REITs that's in our portfolio. And I went and I talked to people, hey, what's it like living here? How's it? And, I got a really warm, nice feeling about the community there. And it just, again, kind of gets back to what I initially said about the tangibility and the realness about these assets, that it's not just some financial, you own a bank, you don't know, hey, I invested in Silicon Valley Bank. How can I possibly know whether they hedge their duration risk or not? And all of a sudden it's the weekend and they're completely insolvent. And yeah, they got bailed out, but you just don't know, right? You just don't know with a lot of stocks what you truly own and what their balance sheet really looks like. REITs have a lot of disclosure requirements and they have to be very open book about their financials. And you can use that to your advantage. And you can use that to, gain some comfort and sleep well at night, knowing that, the asset is not over leveraged. If you want high leverage, you can search for that. You can search for the, geographic disbursement of, what you're investing in. So if a REIT owns a lot of, San Francisco office and you're nervous about that, you can find a REIT that has assets that you like. One of the things I think to look for, kind of like an advanced metric, is refinancing risk, right? And how much of a REIT's debt is coming due that they're going to have to refinance, given that rates have jumped up so much. We of course look at that, for you. One of the things I like to say on Twitter is we think deeply about REITs so you don't have to. But anyone who is investing in REITs would definitely want to be cognizant of that as well.
I'm just thinking out loud here, but how do you potentially hedge for in case of a housing crisis or a very deep recession, a bit like 2008, 2009? How do you kind of hedge for that when you're running a REIT ETF?
So there's a lot of people kind of conflate home prices and REITs, right? So home prices, like let's say in the US, we have this Case-Shiller index, but globally, everyone's always, monitoring, and, housing has become, I think globally, certainly in the US and Canada, it's become increasingly unaffordable, and that creates a lot of risk too to pricing. REITs aren't exactly home prices, right? There are different subsectors of REITs. So you have different asset classes. You have, multifamily and, some housing, single family. You have different residential areas. Of course, we have that. And then you have a lot of commercial real estates. You have, industrial warehouses. You have some assets that are, let's say hospitals or just land, or, increasingly things that don't look very much like real estate, but are real estate-ish. Data centers and cell towers are good examples of that as well. But even when you take the residential REITs, you take the housing REITs, what you get primarily is rental income. And rental income has been historically, during crashes, certainly during the global financial crisis, a lot more stable than home prices for a number of reasons, but significantly more stable. Now, that doesn't mean that residential REITs are completely immune or protected from a housing crash. We see, based on the current supply demand imbalance, based on migration trends, based on various demographics, we think that we're quite bullish actually on residential prices. We think that they're going up. They are historically expensive. We think they're going to become even more so. Like it or not, that's the trend that we're seeing, and that's the demographic trend as well. So, I guess long way of saying, you can hedge, against financial assets. You can certainly hedge against, rate hikes. You can hedge in a number of different ways. But I think it's also important for people to understand that REITs and housing prices are not exactly the same thing.
Yeah. All right. Yep. I understand that. Okay. And the last time I looked, I think it was about 3 or 4% of the total market cap of the stock market is formed by REITs. How far do you think that sector can grow? Do you think it can grow much bigger to 3 or 4%? And what's your kind of projections?
Substantially more. So right now, listed public REITs represent 6% of commercial real estate in the US. And everything, I know, you're in Korea. I'm sure your audience is around the globe. A lot of my data right now is US centric, eventually to be global. But, the two funds we have are primarily focused on the US and Canada. 6% of the commercial real estate in the US is listed. So, that number alone is going to go up. Asset managers in the US own about half of all the stocks on behalf of their clients. They own 3% of the commercial real estate. So it's very easy to see this asset class becoming increasingly a focus of the listed markets and the asset management world over time. I think that's going to happen. I think it needs to happen because you get better liquidity, better governance, and all sorts of benefits to being listed publicly. So, I wouldn't be surprised if we see a double or even triple over the next 10 years.
Yeah, I tend to agree with you on that because, everybody owns a home, right? And lots of people own businesses, but there's so much goes into buying a home, maintaining a home and all of those things. And people are primarily, I mean, people live in their houses, but a lot of it is primarily a way of them being able to store of value for their money, right, into homes. And it's such a headache that I can see a lot of people being attracted to say, oh, look, I want some real estate exposure, but it's much better off for me to do that via a REIT.
That's right.
Yeah, I think so. Okay, and in terms of the dividend yields for on REITs, they're generally pretty good, right? What type of investor usually invests in REITs? Is it usually those that want generally a good income from the dividend yields?
The dividends are good. It's not optimized. I mean, if you want to optimize for just the highest yielding possible investment, you're going to end up, in high yield, as it's called, right? Or you're going to end up in other areas. You can tilt REITs towards the highest yielding. Obviously, there's some downsides that go with that. It's really ideal for, the combination of growth and dividend. So investors that do want to take out or reinvest dividends in addition to growth, and that's their long-term outlook. So, we do see the demographics skew typically a little bit older, closer to those retirement years. But there's, there's a mix of both. And, the dividends do provide a lot of, softening on the downside over the long term as well.
Okay. And how important is the actual area of and the demographics of the area that you're actually investing in? Do you spend a lot of time considering not only the quality of the properties that you're investing in and the REITs that you're investing in, but also making sure that it's a growing area with really good demographics?
So that's a great question and a very interesting answer. Over the last 10 to 15 years, the geographic area has not mattered that much on empirically, from a quantitative standpoint. The data just really hasn't moved the needle all that much. Now, we're talking about, a time where there have been a few trends. Everything is, in real estate has gone up since the global financial crisis. There's been this, massive wave of flows into passive market cap weighted. The rich get richer in the stock market in terms of, on a company level, because those are the mechanics of market cap weight index investing, right? The money, as you reallocate, the money goes into the winners and keeps going up that way. So it really hasn't shown up in the data. Now, we think on a going forward basis, a couple things. One is we think there's going to be an increase in the dispersion on a geographic, but we're already seeing that now. We're seeing, cities that are under duress. We're seeing migration trends in the U.S., people moving to the South. Florida remains extremely strong. There are certain areas that are more troubled. You see it in home prices. You can see the dispersion of home price returns is increasing. The variance between the winners and the losers on a geographic standpoint, that variance is widening. And we expect that to continue to commercial real estate and to public market REITs. Now, we haven't seen it yet, but that doesn't mean that we're not going to see it. We think it's almost overdue. So we include that in our analysis, and I would urge investors to include that as well. It is disclosed. It's a little hard to find. There are some good data sources that will help you parse that data. So yeah, I think it's critically important, but it's something that, that has not, it's the kind of thing that people look at in a rearview mirror, oh, wow, why did this REIT do so much better than that one? Oh, they're, one's, heavy in California and the other one's heavy in, Alabama and Tennessee. And then, you kind of see on a look back period what that means, but it's something that I would urge any serious investor to really take some time thinking about.
Yeah. Are you also looking at areas that might have been really knocked down in price, but you think they have potential in the future? Or are you more look at kind of REIT areas where they're already doing very well and that they have a very stable amount of tenants, etc.?
Fundamentally, I believe that fortunes are made. You buy when there's blood in the streets. Be greedy when others are fearful. I believe in that. I believe that to be the case, right? And we haven't had that opportunity for a long time in the investing market. It's very tricky, right? You don't want to try to catch a falling knife. It's very hard to time these things. The data is pretty conclusive that market timers do not do well over the long term. Most are going to lose based on their bets. And you don't want to be making arbitrary bets. Oh, I kind of feel like this is the bottom. I think there will be a bottom in office soon. Right? I'm not calling it yet, but I think it's going to come. I think that subsector is so beaten down for good reason, but it's just so beaten down. And you're talking about, I mean, in some cases, you've got like SL Green is one of the REITs, has these incredible Class A office in prime location in prime cities. Those assets are solid. Those are assets that you want to own, and you can buy them now at valuations that are unheard of in their life. And so you have to be very careful. I wouldn't say, hey, go out and just, buy office because it's been beaten down because it's cheap. Because it's cheap is not a reason to buy. It can always get cheaper. But when you start to see those signs and you start to see, the bottom forming, and you start to see those green shoots and reasons for optimism, and people, maybe they're coming back to the office, or cities are starting to, rebound and address some of the issues that have people afraid right now. When you start to see those signs, don't always look to last year's winner. You don't want to chase necessarily the high valuations of data centers. There's much more money to be made in the asset classes that have been, so beaten down already, as long as you're buying the right assets. So I do think that's a viable strategy. I think it's a valid strategy. I think it's something people should absolutely be ready to do. But, a lot of people are going to lose on the timing of such. So you got to be careful. It's dangerous. You have to be careful. And it's a tough thing to come on a podcast and say, hey guys, go, get ready to buy the most depressed assets, because again, they can always go lower. And there's a lot of luck involved when it comes to timing the bottom. Having said that, when our approach is quantitative, and look, we had at one point, we had last year, one of our better trades was to go long office in the middle of the office apocalypse, and we had some conversations. Hey, should we override the models, right? Because I don't want to have to explain to people why we own office in the middle of an office apocalypse, right? And the model was telling us, mostly on the technicals, that we wanted to go long, and we did, and it was one of our better trades. So look, you have to have ideally a systematic approach, that you take all human emotion out and you just follow the approach that you set up for good reason. If you're actively trading, then you have to look for opportunities, and the opportunities are sometimes not obvious. Sometimes there's a little smell to them. That's why they're opportunities, right? But you have to be careful. And I don't want to be advocating for people to just go long, depressed assets just because they're depressed. There has to be a good reason to do so. But I think those reasons are coming. I think those opportunities are close.
Yeah. How are the occupancy rates for offices now, and also and the rents for office buildings? Have they somewhat stabilized? Because I know obviously a lot of people, there was the work from home initiative during COVID. It lasted a lot longer. But I have heard a lot of announcements from lots of big companies that they want employees in the office a certain amount of days per week. So I think that's becoming more and more pressing.
I mean, a lot of employees are a lot of big companies are long. They own the office buildings, and they don't want to have to depreciate them, right? They don't have to write them down. There's different reasons for it. Yeah, they're stabilizing a bit, but they're stabilizing, as you might expect. They're stabilizing in the Class A real estate, right? They're stabilizing in the booming cities more so than they are. I mean, Chicago office is still not a place that's that looks like it did 4 years ago. Not at all. So it's starting to stabilize, starting to rebound a little bit, but not democratically, not evenly, right? There are winners and losers, and there are going to be winners and losers. You have always a flight to quality, so the best office buildings are going to fill up again first. I am seeing anecdotally and in news, I am seeing a lot of companies require return to office, more time in office. But look, we're doing this. You're in Korea, I'm in Detroit, right? And we're able to do this pretty seamlessly. It's not a trend that's going to go away. Early in my career, I remember like the panic. I had to have a plumber come or go to a dentist during a work day. And it's like, oh my God, how am I going to, explain this to my boss that I have to be out of the office for a few hours? Now we all have a lot more flexibility about that kind of thing. And I think it's a great thing. I don't think it's going to go away. Even people that are back in the office, by and large, you get like one day flexible, or, if something comes up and you have to work from home because you're not feeling well, or you have a home repair or whatever the situation is, people are much more forgiving about it. I don't think that's going to go away, but there's still a finite amount of Class A prime real estate in prime locations in prime cities, right? It's not like, these things are, it's not like there's no demand for, having great office space in the best places. There is demand. There will always be demand. These are incredible buildings. Look at any skyline. So, even if we don't have a complete return to office looking like it did 5 years ago, there is still demand for that office space. And there's still, a growing number of companies and a growing number of employees in the desirable locations that are anxiously waiting to fill that space. So, it's like everything else, it's complicated.
Yeah, I think you're right. I think it will depend on the area, but I think it will also depend on the industry as well that you're in. For like, so I was thinking of San Francisco. There was a mass exodus of offices there because a lot of people who work in tech can work from home, right? It's a lot easier for them to work from home, so they have this thing.
Sure. And I think there are other issues with San Francisco. Obviously the homelessness and the crime are tragedies. And a lot of people are, I mean, at least look, I don't live there either. I've, been there recently and, I see what I see online. But those, humans have a tendency to course correct, right? And those issues, like when those issues look the most bleak is when people get serious about correcting them, and they do, and they will, right? So everyone who's like, oh, San Francisco is dead, it's never coming back. I don't agree with that at all. I would love, again, with all the caveats I said before about, getting the timing right and, prudently. But when the time is right, I would love to buy the bottom of San Francisco. I'd love to. You got to be careful with it. And again, our ETFs are all systematic rules based. This is, it's just kind of me trying to, pick up on the zeitgeist. And yeah, exactly. So, it's an interesting thing to watch. And I think it's gonna stay interesting. Again, I just kind of go back to be greedy when others are fearful.
Cool. All right. And on the commercial real estate side, is there any commercial real estate REITs type of industries that you are really bullish on at the moment? So whether it's healthcare, hospital type REITs or cannabis type REITs, I don't know, whatever that might be, which sectors do you think hold good value at the moment?
So again, we think residential is the place to be. In the environment that we're in today, I love residential. There are a few that, the ones that make me the most nervous are the ones that have the valuations that are, not justifiable. So, and specifically that would be data centers. The AI narrative, the AI story is so great. It's such a great, I mean, AI is, for someone that can often be a little cynical about things, I think AI is truly game changing. It's amazing. And every couple of weeks I go down the rabbit hole of what's new in AI, and you look at some of the stuff. Everyone knows ChatGPT that we've been using for a while, but the stuff that's coming out on a daily basis, the innovations are absolutely mind blowing. And a lot of people think that data centers are kind of a proxy for investing in AI. One of the papers that I wrote recently talked about how it's actually the opposite. So you have this idea called Moore's Law, which is that the computing power doubles every few years. I forgot the exact calculation. And you look since like the 1970s, and this trend has held. It's incredible. This Moore's Law has been incredibly predictive and accurate. I wrote a paper called Eroom's Law, which is Moore spelled backwards, right? What's the flip side of Moore's Law? The flip side of Moore's Law is that the technology, the hardware, the physical technology that's meant to support the tech becomes obsolete at the same pace, right? Increasing obsolete. And if you think about a computer you had 10 years ago that's not even usable now, right? Look before that when you had a VCR or a CD player, which is like, completely antiquated, right? And that's going to continue. When you invest in a data center, the way a data center works is they raise a ton of money, they buy a bunch of equipment, and then, through CapEx, and then they recoup it over time. And as the technology for AI is increasing and the velocity of its increasing is so high, these data centers are becoming obsolete at a quicker and quicker pace before they can recoup. So they put all this infrastructure in place for technology that has a shelf life that's smaller and smaller, right? Yet the financials of it imply that they're going to be able to recoup for, in some cases 20, 30 years on the same equipment. The valuations of these data centers have been, astronomical based on this, AI narrative and based on this, market cap passive investing flows that have just been pushing them higher and higher. I think it's going to come to a head. So I'm very wary about that sector in particular. But I think, the sectors that are more, tangible and real, that have, prudent valuations on a historical basis are the ones where we focus on.
Yeah. Yeah. I guess a lot of hype's gone behind those data centers, and there's probably been a oversupply as well, which makes it less valuable. Okay. And I also wanted to ask you how you benchmark your ETF against the industry. Which type of benchmarks are you using?
So we use VNQ, which is the leader on the ETF side. It's just a passive market cap weighted. It's interesting because that happens to be the Vanguard fund. There's a number of funds that are, or indexes that are just, all US listed real estate investment trusts weighted by market cap, so the biggest to the smallest and such. And when you market cap weight REITs, like in particular, like market cap weighting, passive indexing, you can argue whether it makes sense or it doesn't. It's optimized in the long term. It's been doing very well. Of course, the flows into it based on cost of the funds drive a lot of the investment return on a historical basis. Question is if that would ever unwind in a sell-off. Real estate is interesting because in the REIT sector, for whatever reason, market cap weighting is even more prevalent than it is on the broad market with stocks, but it makes even less sense. So, the idea of passive market cap weighting indexing is I just want to own the market represented by whatever the market says is worth. So I just want to own, I don't want to make any bets, right? Well, with real estate, because publicly listed REITs only cover 6% of the commercial real estate market, you get a very small segment. And in that small sample, you get a lot of distortions of weightings by subsectors and geographies. It's not representative at all. And, I talked about cell towers and data centers, highly overrepresented, right? Other asset classes are very underrepresented. So, it doesn't necessarily make sense. What you have that's dictating your asset mix, your asset allocation in a passive market cap weighted fund for real estate, what's the determining factor is whether the CFO of a REIT decides he wants to list it publicly on the exchange or not, right? They're the ones making your decision, not you saying, I want to be in a hospital REIT or a marijuana REIT, a land REIT or not, right? So I think these things don't matter until they do. And historically, the market cap stuff over the last decade have done just fine, so nobody's really worried about it. Mostly it's done fine on the strength of the data center story, which you could argue might be nearing its, full maturity. I think people need to think a little more critically about, their REIT allocation, what they're invested in and why, rather than just saying, hey, we're going to default to market cap weighting, to passive indexing, because you end up with a mix of REITs that are not necessarily well thought through. They're not by design, and they're really by chance more than anything else.
Yeah. Is it quite similar to, like, say you invested in the S&P, for example, right? Or the NASDAQ, and then obviously you get a huge weighting of NVIDIA or Microsoft, etc. Is it quite similar when you're investing with the very large REIT ETFs, those kind of benchmark ones where you get a really high proportion of basically what's hot at the moment?
Yeah, you're always chasing the winners. So if you think about an index, market cap weighted, so a broad index, right? When you rebalance the index, right, and everything is trading at their market cap weight. Some stuff goes up, some stuff goes down. The stuff that goes up, right, when the next rebalance comes or when the new money comes into the fund or the index, it's going to buy at the higher levels, pushing it yet higher. So you get this momentum effect, which works great in increasing flows, but it doesn't work forever. So, we're coming off of a long period where it's worked very well. People moving from active to passive has helped. The market performance over the last 15 years has certainly helped quite a bit. It's a momentum effect, but that does come to an end. Everything else in the market, it's cyclical, and, you're buying these assets that have been bought up at their peak valuations now relative to the, the median. So it's very much in play, very much, it's a big risk that people are not looking at. Because again, people are just looking in the rearview mirror. Whatever's worked fine has worked fine. They're happy, they're complacent to a large degree, and there are less market, price setters that are using these valuation metrics on an active basis because there's less money going into active. So, a lot of passive investors are at risk more so than they realize.
Okay, so that leads on quite well to, do you differentiate your ETFs against some of the larger REITs? How do you differentiate yourselves?
So, again, one fund is, and I can't name the fund ticker here, or, it's a big compliance issue, but I'm sure an enterprising investor can go find it. But, one of them is very simply, the residential REIT subsector, which we are extremely bullish on now based on demographics, based on supply demand imbalance, based on the stability of the rental income, and based on what we're seeing now as the end of the rate hike cycle. And we've taken that fund and we've gone to an equal weight approach to bump up the smaller REITs relative to market cap weight, bump them up within the portfolio. So they're all equally represented. The smaller then have a bigger economic impact than the larger, and the smaller are increasingly being taken out and bought out at high prices. And that's led to very strong performance relative to the benchmark year to date. And, we're extremely bullish on that going forward. The other fund is, again, we're using the REIT factors that matter. So what are real estate specific metrics that really matter over the long term to these REITs, right? So we're looking at, you mentioned geographies. We're looking at geographies. We're looking at dividend growth. We're looking at reinvestment risk, right? Why? Because rates are so much higher than where people had financed just a few years earlier. That's a major risk that not everyone is looking at. We have a number of proprietary factors that we're looking at. Ultimately, we want to make sure that we are, invested in the right REITs and, tilted the right way with the right weights for our investors.
Yeah. Okay. And I wanted to ask as well about the interest rates. So interest rates have started to come down. At the last meeting, they reduced them by 50 basis points. How much of effect do you think the lower interest rates are going to have on the residential market? Because I know that there hasn't been a lot of inventory on the market while interest rates have been really high. Do you think it's going to have a major impact on the residential real estate market?
It's going to be very favorable for mortgage and refinance rates to allow people to come back in and invest on the private side where they haven't really, they've been inhibited by, higher rates. I mean, they're not even that high historically, but higher than people expect, higher than it's been. Rates coming down. Look, I mean, so, based on where we are, markets at all-time highs, inflation still lingering, you can make the case that central banks should not be lowering rates. And I think that's a very fair case to make. I might even agree with it. I do agree with it. But we're investors, right? We're investors. We have to play the market. And we know that the central banks have a bias towards lower rates, favoring investors rather than, inflationary impacts. They have that bias, and they're going to lower rates as soon as they have the opportunity to do so. We just had a first cut. They are going to try to get rates lower. We know that. So, you can talk about it, speculate about it, but really what you want to do is you want to invest with that. Now, rates still have a long way to go. You referenced higher rates make it harder to finance new construction, harder to finance different deals, some, office to residential conversions. A lot of things like that are being held up by the rate environment and will come back into play. And they will. It's a very long process. It's a long cycle. It takes a long time to build these things. So I don't think we're going to see like a huge influx of inventory overnight based on lower rates, but we will see significantly more liquidity come into the market, and that's going to be favorable for the asset class.
Okay. All right. And I've seen you mention elsewhere, I think it was on LinkedIn or maybe your Substack, where you mentioned about the BREIT debacle, which happened with Blackstone. Can you go into a little bit of detail into what happened there and what caused it?
Yeah, it's amazingly, the shit hasn't hit the fan. This is still out there and people have stopped talking about it, but nothing's really changed. This is a private REIT fund where, liquidity had kind of dried up. It's $70 billion in assets, but a little bit of leverage in the fund. So $120 billion of commercial real estate. Liquidity had dried up. They had to gate the fund so investors can't get out. And it's a difficult situation for them to manage it. They own great properties. It's not like an FTX type of situation. It's not like a total Ponzi fraud. But here's the thing is that the valuations that they were coming to on the fund were not declining with the market. So the publicly listed REITs in real estate had been dropping. And this private real estate fund was stubbornly keeping the NAV, the value that the appraisers came up with, at the same values at the all-time highs, which defies any reason or logic. And you could say, okay, look, they want to have their fund marked high. Maybe they came to it honestly, and I just happen to disagree with it. That's fine. But there's no mechanism. When they gate the fund, you can't get out. So you're paying fees at the high rate. You could say a questionable rate, right? With no way to get out and new money coming in at these high rates. It was a very questionable thing. And, you kind of had a perfect storm at once. You had a bunch of redemptions, no liquidity in the private markets, cost of capital rising. They had to actually incentivize with a preferable waterfall return, incentivize University of California to make a large investment just so they can satisfy the minimum redemptions, even when the fund is gated. That's some minimum redemptions that they had to provide liquidity for. So, it's a very difficult situation. There's still a lot of people in this fund, mostly, sadly, retirees or people that think they're in a very stable, safe fund. It's a very expensive fund. There's, selling fees and there's performance fees above a hurdle. There's, fees that are significantly higher than you get in an ETF or on the public market, but mostly the valuations that you're buying in at or that you're not selling out at are significantly higher than you'll get in publicly listed REITs. So, we put out a paper on this. We showed our math. We showed our numbers. If anything was wrong, then, I'm happy to correct it. We're not like, we have no vendetta here or no, instead we're just trying to call it like it is and, share our work. And we've done that. And investors have by and large not heeded our warning. And that's their prerogative to do so. But it's a little concerning. And I think the final chapter of this story has not yet been written.
Yeah, it's quite a tough area, isn't it, really? Because I think with real estate, it's very hard to tell the level of volatility that's happening on a day-to-day basis. So when you look at shares go up and down every day, there's lots of liquidity, people pull in, pull out. But it's a bit different with real estate, right? And with properties, because they don't go on sale every day and the prices don't change every day, right?
This is a tremendous issue, very important issue for people to be aware of, not only for real estate, but for any private asset relative to public asset. Quite simply, if never mow your lawn and you'll check on it a year from now, you say, wow, this thing grew. But in reality, if you measure it every day, you'll see that after rainfall, the grass grew and other times it didn't. The frequency at which you measure volatility has a big impact on that volatility measure, obviously, right? And with a lot of private assets being valued, not only valued less frequently, but also in many times valued based on appraisers or humans who have their own bias, their own human bias towards their previous marks. So you're less likely. If I told you that my nephew's app that I invested in is worth $3 million last month, and you come to me this month, I'm very unlikely to give you a number that's significantly different than $3 million. The public markets don't care, right? If rates are going up or down and there's, exogenous events, there's COVID, people are trading REITs, they'll move on a daily basis wherever, in a mark-to-market way where buyers and sellers meet, right? People are voting with their dollars. You don't have that in the private assets. And that's okay because it's just, they're fundamentally different in certain ways. There are ways to manage it. It's called the smoothing effect, right? The asset looks smoother when it's traded on private markets. And there are different formulas that you can use or ways that you can manage the smoothing effects so that you're not tricking yourself into thinking you're buying something less volatile than the other thing just because of, the structural differences. But there are a lot of instances where purveyors of private funds and private assets are trying to conflate and are trying to confuse and are using the volatility of the private asset in comparison to public assets without disclosing those differences and trying to say that it's less stable. And that's simply not the case. It's dishonest to say so. So, investors need to be aware of it. They have to be aware of, what's called the smoothing effect. And, that standard deviation is not necessarily the best measure of volatility. I mean, this BREIT fund in particular, the volatility, it looks almost like a flat line up and to the right. It's at, very few drawdowns. And it's great, but it doesn't mean that there's no drawdown ahead, especially given where, the valuations, we think they're significantly inflated. That's a huge risk for volatility ahead, as opposed to the public market REITs where you're looking backwards to say that they're more risky, when in fact, we think the valuations today give them a lot of stability on a going forward basis.
So the smoothing effect is pretty important to be able to make sure that people aren't getting tricked or not just tricked, but just not over assessing their assets that they have in their REITs.
It is absolutely critical for investors to understand it and to normalize it when they're comparing public versus private assets.
Not financial advice, but do you have any other recommendations for people that are maybe new to this asset class? Maybe whether they're considering investing in individual REITs, not ETFs, REITs from publicly listed, or whether they're looking at REIT ETFs. Do you have any kind of recommendations for things they need to kind of look out for and things they need to think about when they're assessing what they're going to do with this strategy?
Yeah, I think, one of the wonderful things about these REITs is they have tremendous requirements on the disclosure side with their financials. And I would urge investors to take advantage of that, to read, to learn, to understand, what's on the balance sheets and what isn't, where the assets are held, what the subsector exposures are, what is the AFFO? What does that mean? Where can I find it? How is it disclosed? There's some great resources out there, and NAREIT is a great place to start. But it's a great thing that you can do a lot of fundamental analysis on these REITs because they have to disclose quite a bit about what they own in their financials. And you don't get that with a lot of assets. Like I said, with Silicon Valley Bank as an example, there are even huge public companies where it's very hard to understand exactly what the company has, what the company does, how they make money, what the risks are. With REITs, it's a lot easier to be able to decipher those kinds of things. So I would urge investors to, take an interest in that and, not just chase the shiny object or chase the hot thing, but to really understand what you're getting. And I think it's a wonderful place for value investors to be, but really any investor that is serious about their due diligence, I think it's a great asset class to be in.
Yeah. It's quite similar to the banks in a way, where they have to put all their disclosures in there, and there's lots of ways of being able to find out more details about the bank. I suppose it's quite similar with real estate, right?
Yeah, 100%. In fact, it's even more so because banks have so many, financialized assets, and there's so many risks that are not apparent, based on trading or hedging or not of different exposures. I'd say it's significantly better than that.
Yeah, especially after 2008, 2009, I'm sure they got a lot more stringent on that. All right, excellent. Okay, all right, Phil, how can people find out more about you? And also, how can people find out more about Armada ETFs?
Armada Investors is probably the best place to go, armadainvestors.com. We have the ETF website is armadaetfs.com, but there's better stuff on the investors. That's where we put all of our blogs and everything else. I am on Substack. It's Backstack, my last name, BAKA Stack. And on Twitter, it's Phil Bak 1. And yeah.
Okay. All right. Excellent. Well, I will make sure I leave the details for those in the description below of this YouTube video. And really thank you for your time today, Phil. We had a really good time talking through all about REITs and real estate. And I think that the listeners will get a great deal from the conversation. Definitely if they're thinking about dipping their toes into looking at REITs more. So thank you very much for your time. I really appreciate it.
I appreciate it. I'm happy to be here, and thank you. And thank you to the listeners for your time.
Thank you.